prices are hovering around these 200-day moving average lines after a solid rally from the June lows. And that's not too bearish. And I believe we have further upside potential to go within the next few weeks. Because looking at the Dow Jones index, it completed a falling wedge pattern by mid-July by breaking above the steep falling trend line around 31,250. And that suggests that prices will rally towards the April high around 35,375. That should be the target of this falling wedge pattern.
Yeah, that's really
on a short-term basis, I must say, we could see some. It's a little bit toppish, so a pullback would not surprise me. But I believe the downside potential should be very limited, and a decline towards the 200-day exponential moving average line, currently around 33,280, could be the next buying opportunity.
Really interesting, because the most people that we speak to who come on our show tell us that they don't think that this is going to be a sustained bull market rally. In fact, they just see it as a bear market bounce. But of course, many people didn't participate in it. Let me just ask you a question about breadth. What are your technical signals telling you about actual market participation in the most recent rally?
First, I have to say I totally disagree that this is a bear market rally. I think that the whole discussion is somewhat clouded by the beginning of this year, where the question was, will markets enter a bear market territory or not? And of course, we classified the bear market by a decline of 20%, and for instance, the Nasdaq 100 index declined from its highs around 16,760 towards the recent low above 11,000 by 34%, and that should be classified as a bear market. But if you take this into consideration, the sharp rally from its March 2020 lows after this COVID crash, the Nasdaq 100 index rallied for almost 250%. So giving away 34% of this stunning rally is not that strange, isn't it? So I believe market participants are way too bearish at the moment. That doesn't mean that the stock markets will be very vulnerable within the coming weeks to next few months, with September and October ahead. But I believe you should buy on weakness and not selling on strength, as an explanation that this is a bear market rally.
Okay, very interesting perspective. Let's turn to foreign exchange. We had an FX guest on the show earlier who was saying that despite some of the recent bearishness in the dollar, their company still is quite positive on the outlook from the US dollar from here, namely because the Fed is still so hawkish. What are the technical signs that you're seeing for the DXY?
Yeah, I agree. Looking first, you should see that the interest rate differential between the US and Europe should widen further. That's the first comment I have. And secondly, if I look at the euro dollar, it broke below the 103.60 support level. That's a very crucial horizontal support in the weekly chart. And that suggests that there's further downside potential to go. Longer term target between 80 to 75 cents within the coming months. And on a short-term basis, prices are consolidating above 102.25 in the daily chart. And if we would see a break below this support level, we could easily see a decline towards the lower end of the falling trend channel around 97 cents in euro dollar. But this will be a process to achieve lower levels. But definitely this close below the crucial horizontal support at 103.60 is very bearish for euro dollar. And it confirms that there's also dollar strength in combination with euro weakness.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.